Ladies and gentlemen, welcome back to the channel and welcome back to your January 13th, 2025 market update, where we share with you the biggest news moving our markets, technicals on your major indexes, big data, and what could be coming next for stocks. Basically, this is your one-stop shop if you are an investor that watches markets every single day. First and foremost, major indexes are mainly moving lower. Russell 2000 is down 1%, NASDAQ down almost 1%, the S&P 500 is down 0.39%, whereas the Dow is really the bright spot today, up almost 0.5%. Oh yeah, and the VIX broke above 20 today. Currently at 19.94, up 2%, but for the most part of the day today was above 20. Some of this decline on markets today has to do with news out from Nvidia, where Nvidia's top customers face delays from glitchy AI chip racks. This article from The Information says some of Nvidia's biggest customers are facing new delays in getting its most advanced artificial intelligence chips up and running in data centers. The first shipments of racks equipped with Nvidia's newest chips, Blackwell, have been plagued by overheating as well as glitches involving the way the chips connect to one another, according to 3 people working at suppliers and 2 customers that have dealt with the issues. I mean, we don't really know if this is current, like if this is what's happening now, or if this is what happened before. We already knew Blackwell was facing some issues. Nvidia said they are all worked out and things are fine with Blackwell, and now we're getting this news again. Nvidia also took to X to slam the Biden administration. Nvidia says, quote, "The Biden administration's, quote, AI diffusion rule will stifle innovation and undermine America's global technology leadership. Restricting access to mainstream computing risks derailing AI progress for industries at home and abroad. America's strength lies in innovation and competition. This rule will only harm the U.S. economy, set America back, and play into the hands of U.S. adversaries." As a consequence of these 2 stories today in the AI world, Nvidia is down 2.3%, Apple is down 2%, Meta is down 2%, Microsoft down 1%, Google down 1%, Netflix down 0.5%, and Amazon as well down 0.5%. So big tech really taking this news on the chin today. But we did have some good news today as far as inflation expectations. New York Fed says December 3-year ahead expected inflation at 3% versus 2.6% in November. But the 5-year ahead expected inflation at 2.7% in December versus 2.9% in November. So 5-year inflation expectations came down quite a bit on a month-over-month basis, and 1-year inflation expectations pretty much came in line with expectations. You could see here the consumer inflation expectations 1 year ahead were expected at 3%. They came in at 3%. Some expectations actually had this at 3.1%. So by some people's metrics, we actually beat as well on 1-year inflation expectations. Now, 10-year Treasury yields, as they have retreated somewhat today, did hit a new 52-week high. As you can see from this yellow bar here, we did hit 4.80%. Just within the last 30 minutes or so, they have come down a little bit. But yeah, 10-year Treasury yields continue to be a major drag on our markets. Now, this 52-week high precedes the PPI data that we get tomorrow, and what some people are now calling a buyer's strike in the 10-year Treasury market, which makes sense. People don't want to buy 10-year Treasury yields right before important inflation data. From a principal perspective, when prices of bonds fall, as you will see on this chart from TLT, when prices fall, yields go up. So prices have been falling a lot recently. Well, if inflation comes in hot tomorrow and on Wednesday with the CPI report, prices are going to fall even more and yields are going to go up more. So why would you want to step in right before the inflation data and take a risk that you're instantly going to lose money on your new bond purchase? You probably don't want to do that. So I think it's building up a lot of anticipation for the inflation reports. Meaning, if the inflation reports are good coming tomorrow and on Wednesday, we'll discuss in just a moment, you could see a lot of buyers step into the Treasury market and yields could fall a lot. Tomorrow morning, we will get the NFIB Business Optimism Index. We are expecting this will fall from 101.7 last month to 100.8. We are going to get PPI month over month. On a headline, we're expecting 0.3%. Last month was 0.4%. So you are expecting headline PPI will fall. For anyone that does not know the difference between PPI and CPI, PPI is Producer Price Index or Producer Price Inflation. CPI is Consumer Price Index or Consumer Price Inflation. Doesn't matter the terminology you want to put on that. So PPI is like this mug company. Apple, this mic company, which is Blue Yeti. So really PPI is just companies' cost, whether they are going up or falling. CPI is our cost if the things that we are buying are going up or down. When producer prices go up, well, consumer prices tend to go up after. So PPI tends to lead CPI. And that could be the issue if PPI comes in hot tomorrow morning. We're not really expecting a super hot number, though. So if we meet expectations, that's probably good enough for markets to rally from here, at least a little bit. If we come in lower than expectations, you could see quite a big rally. Now, again, core CPI expected at 0.2% month over month. That would be a great number versus last month at 0.3%. That would really calm some nervousness in markets, I think. Year over year, CPI expected to remain unchanged at 3.3%. Inflation headline month over month expected at 0.3% versus last month at 0.3%, so essentially remaining unchanged. And inflation year over year is expected at 2.8% versus 2.7% last month. So to move upwards a little bit. Now, also after the CPI data, we get more data. We get the New York Empire State Manufacturing Index at 8:30. Fed Barkin speaks at 9:20, and Fed Kashkari speaks at 10 o'clock in the morning. Fed Williams speaks at 11 a.m., and Fed Goolsbee speaks at noon. And then finally, to end off the data dump, we have the Fed Beige Book at 2 p.m. And Jerome Powell says, hey, the economic data is noisy. If you want a better understanding of what the economic data looks like, just read the Fed Beige Book. He said that 2 FOMC conferences ago. So that's something I have been watching a lot. It did improve in the last one versus the prior one. So that was good. And we want to see what it says again, because I think that's what the Fed is really looking at versus some of the noisy, economic data. Now, for the first time in a long time, CNN's Fear and Greed Index is at 25, which is now an extreme fear. So if you know a bull out there, go give him a hug. If you know a bear out there, tell him, hey, maybe we're a little too bearish because everyone else is bearish. And show him the CNN Fear and Greed Index and tell him, hey, we're in extreme fear. This is usually a good buying opportunity. If you know a bull, I'm sure they've already bought a lot and they're not liking this too much. Now, we have 7 fear and greed indicators. First one is market momentum. That is the S&P 500 and its 125-day moving average. That's an extreme fear. Stock price strength is the net new 52-week highs and lows on the New York Stock Exchange. This is by far the worst that we have seen in the last year. Keep in mind, in April of 2024, we had a 7% drawdown, and you still were positive. That means more stocks hitting 52-week highs than 52-week lows. And on August 5th, that completed a 10% correction in markets, and you still had 4 or 5% of stocks hitting new 52-week highs versus lows on the New York Stock Exchange. Today, this number is negative. So it's negative 3.5%. So 3.5% of stocks are hitting new 52-week lows versus essentially none that are hitting new 52-week highs. Yikes, that's bad. Stock price breadth, you haven't been this bad since June of 2024, but you're even worse than that now. Okay, coming in and in extreme fear. Put and call options, also in extreme fear. That doesn't tend to happen all too often. Market volatility is neutral. Safe haven demand is in extreme fear. And junk bond demand is currently in greed. Now, my favorite indicator is the percent of stocks trading above their 50-day moving average. This just really shows you how broad-based a market decline is. Okay, because this incorporates everything, every sector, every stock out there. Here on the day today, 25.5% of stocks are trading above their 50-day moving average. That means 74.5% of stocks are in an active decline or trading below their 50-day moving average. In fact, every single sector in the S&P is trading below its 50-day moving average. That has not happened in a long time. This has not happened in a long time. The last time we were this negative was October of 2023, where we ultimately hit a low of 20% of stocks trading above the 50-day moving average. So we're almost there. Okay. So what happened in October of 2023? The S&P had a 10% correction, like on the money, 10% correction from the highs in late July until the low on October 27th. Now, if you look beyond that one instance, the last time you were this bearish or this negative or this many stocks were in an active decline all at the same time, it was September, October of 2022, coming out of the biggest bear market we have seen in 15 years. Okay. And at this point, markets were down almost 27% from their all-time high. That is how bad markets are right now. Now, when you look at the S&P, this looks like a baby fall compared to anything, we've seen over time. There's one characteristic that is very different this time versus every other drawdown we've had since 2022. And I'll explain that in just a moment. The S&P is currently down about 4.68, call it 4.7% from all-time highs. At the lowest point, it fell about 5.24%. Okay, and that was at the low of the day today. It looks like we're going to close towards the high of the day. So halfway through what most would call a correction. In the RSP, which is the equal weight S&P, you fell from peak to trough 8%. From where we currently are, you're still down about 7.5%. So things are worse over here with the RSP. The one thing that is different this time around versus any other drawdown we've seen in recent history is the participation of the drawdown. See, in other instances in time, over the past 2 years now, you've gotten market drawdowns. But the market drawdowns we've gotten, you've had some area that's held leadership. You've had big tech that has held leadership, or you've had healthcare that has, held some leadership. Right now, it's broad-based. Everything is declining. Cyclicals, value, dividend, healthcare, industrials, materials, small caps, tech, software, AI, everything, mega cap tech, everything is declining at the same time. That could be good and bad. That could be a good sign for when things recover. If PPI and CPI come in good over the next 48 hours, perhaps you're going to get a broader based recovery. It's not just going to be as concentrated in big tech. Bad news is we don't have any real leadership here. So like we've seen over the past 2 years, anytime we've kind of went through a correction, big tech has held us up. So we didn't fall as much. Well, we don't really have that big tech leadership today. So if we fall, if markets get weaker, big tech's going to participate and fall as well, maybe even fall more than the S&P, and that could lead to a larger drawdown. So I think we're really at a make or break it point for the broader markets here over the next 48 hours. If inflation comes in hot, we could be coming down another 4% and some change down to this 200-day moving average at about 553. That would be a drawdown of about 4.5%, and that would be almost a 10% correction from peak to trough. That is where I would hope that markets find some support. If we don't, if things get just really bad and we start talking about the Fed that maybe needs to raise rates, then you're going to fall back to about 520, which is a drawdown of 14% peak to trough, or to our August 5th low, which would be a drawdown of 16.5% from peak to trough. That would truly be remarkable if that happened. I'm not going to say it couldn't happen, but I think that's unlikely at this point. For anyone that is watching today before the PPI data comes out tomorrow, I do think it is a good sign that TLT caught some demand, okay? Because when bond yields go up, as they have been, that means bond prices are falling. So that means there's selling pressure in the bond market. What happened today is Treasury yields on the 10-year Treasury hit a new 52-week high at over 4.80%. They went a little bit higher than that, but just we'll round here to 4.8%. They fell into the end of the day to about 4.78%. Now, that's not a huge sign of confidence, but there is someone out there that feels good or feels confident in buying treasuries today right before the inflation report. So why is that good? Well, if someone was nervous about the inflation report, then, treasuries would fall if we get hotter than expected inflation tomorrow. So you wouldn't want to buy treasuries today because you're going to get a better price tomorrow. Some people think that perhaps inflation could surprise to the downside, and it makes sense to take out a position today in treasuries. So a little bit of a sign of confidence today, I will say, but not the end all be all. We're in the clear. So let me know what you think about this information down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and let me know what you think about our inflation reports over the next 48 hours. Are they going to come in good or bad? Will they send markets higher or lower? I would love your thoughts on this. I think everyone's opinion is valuable right now because nobody knows exactly what's going to happen. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.